First off, welcome everybody to the first episode of the All Time High podcast. My name is General Moore, and I'm going to be talking to you guys about something I find really interesting, and that is decentralized finance. So today's episode is called The Arrival of the Monetary Revolution, and I'm going to be talking to you guys about why decentralized finance is important and basically how it's going to change the future. So first off, I think I'm going to be starting everything out with a little bit of news. So just to catch you guys up on kind of what's been going on over the last week, some really cool stuff has been happening. First off, a company called MicroStrategy, they're a business intelligence company run by a well-known CEO, Michael Saylor. They held their World.now conference this past week, and they basically released their playbook for the corporate Bitcoin investor. And over 1,500 institutional investors attended the conference, and that is a really good sign for not just Bitcoin, but the future of crypto as a whole. It's a little ironic because we're kind of waiting for these institutional investments, but ultimately this is going to kind of take power away from those institutions, and we're going to talk more about that in a little bit. Also, Visa announced plans to help their customers buy and sell digital assets. So this is another huge step for adoption. Obviously Visa is one of the biggest payment providers in the US, so that's going to provide a really good platform for a lot of new people to get involved. Lastly, PayPal. PayPal is now going to let merchants accept crypto across their, some 29 million vendors on the internet, which is, again, huge step in the right direction. I don't know if I would really want to be spending my crypto right now because I just kind of want to hold it. But it's nevertheless kind of shows how things are moving in the right direction. So let's talk about decentralized finance. What is DeFi? Now, sorry for my crude drawing. I don't have the best thing here, so my penmanship is not going to be fantastic. But DeFi stands for decentralized finance. Now, this is a concept that basically means that we are doing financial transactions and stuff in a way that has no intermediary, no third party, no middleman, right? So right now our financial system is heavily centralized. You have the US dollar, oh my god, which is controlled by the Federal Reserve, right? So the Federal Reserve basically decides interest rates. They decide if and when they're going to print more US dollars, and everybody who uses the US dollar is basically at their will, right? So this, below them, you're going to have the banks, hedge funds, stuff like that. And these parties have considerable control. They can really alter the way that markets work, financially speaking. The banks, you don't even really own your money with the banks. The bank owns your money. You just give it to them for safekeeping, and then they, in exchange, they're going to lend it out. They're going to give it to other people, and then they're going to pay you 0.5%. Kind of a shit deal, honestly. And then we got the hedge funds who, if you were paying attention to the events in the last couple of weeks, severely manipulated the stock market and have been doing so for a very long time at the expense of the retail investor and the middle class. So it's just we don't have a lot of control over what we do with our money right now and how we spend it. If the bank doesn't want you to spend money, they can just say you can't. Kind of something that was happening back more so in 2018 when all this stuff was running up is banks were saying you can't buy crypto. If you have money in our bank, we're not going to let you do it, because it's risky, and they don't want you to spend money in anything that's risky and risk losing funds. That's crazy to me. Anybody being able or having the ability to tell me that I can't spend my money the way I want to is kind of wild. So these things really happen. The Federal Reserve, like I said, they can print money at will. If they need to inject a bunch of money into the economy for whatever reason, which, stuff that's been happening lately, obviously with COVID-19, they can just make more. And this is really damaging to the value of the US dollar, because if you just print more money, the supply keeps going up and the value of every dollar is going to go down. So there's great power in these centralized authorities that make the rules. We can try and follow the rules as best we can, but these people make the rules to the game. And if we start to play the game in a way that they don't like, they change the rules, right? So let's get back to DeFi. And DeFi will basically allow you to send your money where you want, how you want, and you can invest how you want. It truly is a representation of the freedom of money in a lot of ways. Some of the highlights, to me, it is cheaper, or will be. It is more efficient. I apologize for my penmanship. It is safer, and it is more direct, right? Cheaper because operating or running transactions on the blockchain, fundamentally speaking, will be cheaper. You'll be able to send, let's say it's $1 million or $1 for hopefully the same cost, and hopefully that cost being, pennies, right? It's more efficient. All these intermediaries and third parties that your money touches just makes it less efficient. You send a bank transfer to somewhere, you've got to wait 3 to 5 days or whatever for it to clear. So you can't even spend that money. Your money is now locked in a transaction that you're just waiting for it to be finished. Ultimately, this will be safer. The blockchain is a unhackable network, and the only way that you're really going to lose your funds is user error. Oops. So if you make a mistake, maybe it's not as safe. But in terms of the overall network security, it is. And it's more direct. I can send money from point A to point B, and that's it. So if I want to send money to my friend, to my family, to an employer, or rather, other way around, it's going to go straight there. Nothing else is going to happen. It's not going to touch anything in between. So who is this for? I think a lot of people might feel like, okay, well, who is decentralized finance for? Is it for the wealthy people? Is it for middle class? For people who are poor? And the answer is all of the above. It is for everybody. And I think that this is something that people really need to understand, is that centralized finance is not really for everybody. It's for the 1%. It's the people who make the rules. And that's why those people have been able to stay in power and stay so wealthy for so long, is because they control how everything works. So you might also think right now, oh, well, I can't afford a Bitcoin. That's $40,000. I can't afford Ethereum. It's $1,700. That's where you're wrong. You can buy any fraction of pretty much any crypto out there, depending on how they're structured. So up to 9 decimal places, you can own Bitcoin. You can have 0.000000001 of a Bitcoin if you want. So you can make those regular investments. You can continue to kind of build on that foundation, which I think is really, really valuable, right? And that money is hopefully going to appreciate over time. You might also think, well, I don't need that. I live in the US. The dollar is somewhat stable, and I know how to invest my money already. So why would I need this? I think that's a really bad way to look at it, because ultimately speaking, I think long-term, centralized institutions are going to lose a lot of power, which also means that the US dollar might lose a lot of power. And that means your purchasing power could go down. Obviously, nobody wants that. I think putting money in something like decentralized finance, you have a more honest system. It's what they call trustless. And the hope is that over time that all that money is going to appreciate, and that you're going to have a better financial reserve for your future. Blockchain doesn't discriminate. It doesn't matter who you are. If I'm a user running on the platform, it sees me as a number. It doesn't see me as my identity. It doesn't see me as a marketing professional or a rich person or a poor person. My identity is absent of my class status on the blockchain network. So I think that's a really powerful concept. You can find a really nice picture of dollar depreciation on Google. Yeah, actually, it's something that I've been researching a little bit more lately. And the dollar has been steadily just getting crazily inflated over the last several years. I went back to check, out of curiosity, how much the dollar has inflated in the last, I think it was 10 or 11 years. And I think it was 21%. 21%. I don't know about you guys, but I don't think wages have gone up 21%. At least not for middle America and lower. So there's a big growing disparity. The wealth inequality problem is already very significant, and it's only getting worse. Over the course of the pandemic, it's been the greatest transfer of wealth that the world has ever seen, and not in the good way that we want. It's been transfer of wealth up to the top. I mean, you can go and see how much Bezos has made off of Amazon. I mean, Amazon has just absolutely gone bonkers since the pandemic began. It's part of the reason why the wealth gap continues to grow. Exactly. And we're not really doing anything to fix it, right? Even now, there's all this hype around what the hedge funds have done with GameStop and Robinhood, and it's already starting to die down a little bit. We're not really talking about it anymore, and that's a huge problem. We're not making these people pay for these monumental mistakes that they're making, and they're fucking over a lot of people. A lot of people lost a lot of money. So, moving on, we can talk about the different modes of DeFi, I guess, is what I would call it. This is more so like the different types of platforms and stuff you would find in decentralized finance. So, you have decentralized exchanges first. And this is very similar to stocks, right? Stock market. So on decentralized exchanges, you can go on and you can trade currency. There are tons of different trading pairs for different kinds of cryptos. And this is completely decentralized. There's nobody running the exchange. There's nobody that makes the rules for the exchange. There's nobody that can halt trading because they don't like the way that the price is trending. This really is a completely democratized way of trading assets, right? And you can actually earn money by participating in how these exchanges work. So you can do things like provide liquidity to the different trading pairs, and you can earn additional coins both off of the trading fees and doing something called yield farming. Oops. You can also participate in the process by holding the token. So, examples of this of projects like this are Uniswap. I recommend checking out, or DYDX. These are both decentralized exchanges. So, if I own Uniswap token, I can vote on how the platform is going to evolve. So, it's called governance. So, if somebody proposes a new upgrade to Uniswap, the entire community or Uniswap holders can go and vote on whether or not that upgrade is going to take place. It's a very, very powerful concept. I mean, now if I was using, Binance or Coinbase, they still technically control what the trading activity, what trading activity is going on their platform. This is entirely democratized, right? Would that be like Coinbase, Kraken? Yeah, exactly. It's like Coinbase or Kraken or Binance, but actually decentralized, right? So actually owned and operated by the users and the token holders of the network. It's really cool stuff. So another type, I think I'm going to run out of room on my thing. Oh, no, let's do this. Another type are lending and borrowing platforms. Your real world equivalent is basically a bank. You can go on these lending and borrowing platforms and you can do a couple different things. You can, give out loans. You can take loans and pay them back over time. You have to put up some form of collateral, and then you can take out X amount of dollars and go spend them somewhere else. Then obviously you have to pay it back. If you provide liquidity as a lender, you can earn really high yields in interest. So right now, you can go on pretty much any of these platforms and get somewhere, I'd say, between 5 and 20% interest. And what I find really fascinating about this is that I don't need to do this with Ethereum or Bitcoin or a volatile asset. I can go and purchase something like USD coin or USDC. This is a stable coin, And they call them stable coins because they're designed for the value to not fluctuate very much. So in order to do that, they basically back this by a US dollar reserve. So if I go and I hold USD coin, if I have $1,000 in USD coin, my $1,000 is going to be $1,000 tomorrow, the day after that, and the day after that. And you can take your USD coin and go lend it on a platform and earn anywhere between 5 and 20% on those dollars. This is a really, really powerful concept because right now, if you go to the bank, if you go check what your interest rate is, it's probably something like 0.5%. Now, maybe 5% doesn't sound like the biggest number in the world, but that's 100 times more than 0.5%. So you can continue to scale that up. $10,000, $20,000, $100,000, and you are always going to earn these rates. This could be huge for people. People will be able to live off interest of their money if they so choose. If you have enough money, but depending. So would these stablecoins and their dollar backing be parallel by the gold standard back in the day? Yeah, it's similar. If you buy USDC, this is I think owned by Coinbase. So you're basically trusting Coinbase that they've got your reserve dollars, right? What are some examples of these lending platforms? I was actually just going to get to that. Thank you for asking. Great ones to check out that are actually decentralized. Aave is a good one. Compound Finance is another one. And MakerDAO. These are probably the top 3 right now. Do you know anyone who has personal experience using these lending borrowing techniques? Yeah, me. I have not yet, but I will say I haven't gotten to do it on any of these 3 platforms yet, and those are because of high gas fees on the Ethereum network right now. I'm going to talk a little bit more about that in a little bit when we get to kind of the downsides of DeFi right now. But there are some good, more centralized platforms that you can try out if you kind of want to get a bit of an entry level on what this stuff is like. So BlockFi is a great resource, I think. You can go, and right now I think if you hold USDC, you get 8.6% back. This is a more centralized authority. This is owned by the Gemini exchange, so the Winklevoss twins. They own this company, and I think more or less you can trust your funds there. So you can go on there and you can actually buy I think you can only buy Gemini USD, but you can convert it to USDC. Either way, whatever stablecoin you have, I think they all earn 8.6% on that platform. So this is a great way to get an intro into it. Long term, I absolutely want to be on Aave or Compound Finance or MakerDAO, but I'm just waiting for an Ethereum upgrade basically to do that. How are these interest rates determined, and why is it that they are orders of magnitude higher than the bond yields, etc.? Basically, the interest rates are variable, so they are determined based off of market conditions. So it is a matter of how much liquidity there is and how much demand there is. So if a lot of people are borrowing money on the platform and demand gets really high and supply gets low and there's not a lot of liquidity, interest rates are going to go up to incentivize people to basically come in and provide more liquidity to the pool so that people can continue borrowing and using the currency. I don't know exactly why it is that they're orders of magnitude higher than traditional yields. I think it's just a function of how the network is designed and basically how those different smart contracts have been designed to determine those market rates. Perfect. So even the lending process regulates itself. Yeah, exactly. It's pretty wild. All this stuff is actually automated. One thing I forgot to mention when we were talking about decentralized exchanges is they have what are called automated market makers. So everything that's happening in the background, what's determining price changes and yield rates, all that is automated. There's nobody sitting back there basically making a decision to change things. It's all based off market conditions. So you don't need a central custodian. You don't need a third party. You don't need anybody to manage those funds because they're going either to the platform or to another user. It's pretty cool stuff. So the next one I want to talk about are aggregators. These ones I think are really fucking cool, but they're really new. So I wouldn't really recommend playing with any of these yet, but I think they're really neat. So aggregators, you have stuff like Finance. And also token sets. I don't know if token sets are officially an aggregator, but it's kind of how I would call it. Maybe we'll go into this later, but I've recently learned that option trading is now available on cryptocurrencies. How do you think this will affect the market? And then we also have, there were ones that were recently hacked. No, yes, Finance, they weren't hacked. There was an exploit, and I'll go into that in a second. And with regards to Heike's question, option trading is available. That is another market of like derivatives and options. Those things are also starting to come out. I don't know enough about derivatives and options to give you like a really good answer. It's on my reading list, but I'm going to be exploring those markets as well very shortly in the future. So we have aggregators. So Finance is essentially a platform that is going to try and earn you the highest yield rate across the DeFi ecosystem, right? So what it's going to do is basically say, okay, you're going to put in your money. So let's say I put in USD coin. Finance is going to go to the Aves, to the compounds, and it's basically going to find the highest interest rates that are available and move your money between them, right? So that you're constantly getting the highest yield possible. They also are going to be doing stuff like this with yield farming and all kinds of different stuff. So this is basically a way that the entire ecosystem is going to operate together. I think aggregators is really fascinating concept because it, to me, kind of shows that the entire ecosystem in itself is not necessarily in competition. They might kind of all be working in lockstep, in other words. So Corn mentions that Finance was recently hacked. They weren't really hacked, but there was an exploit. So this is one of the big dangers when we are working with DeFi platforms right now, is that user error is still a thing. Oops. So because user error is still a thing, even though the blockchain technology itself, the Ethereum network itself, is not exploitable or hackable, smart contracts that people deploy on top of them that are written by people sometimes are not perfect. So every once in a while you might have an exploit in the code that somebody is going to be able to abuse and make a lot of money. So this happened just this past week. Finance, somebody discovered an exploit with their flash loans, is what it's called. And basically this person just took out like an endless amount of flash loans and did some crazy magic wizardry stuff and made like millions and millions and millions of dollars. So again, this is the danger right now. This is part of what it means to be an early adopter, to be an early user, is that sometimes you run into these problems, right? So token sets is another example that is similar to an aggregator. It's not quite the same, I think. But anyways, I'm just going to talk about it and what it is. You can go on token sets and you can basically find different types of portfolios to invest in. So there's a DeFi index on token sets. It's pretty cool. And basically it holds, a small amount across the DeFi ecosystem. So there's Aave in there, there's Uniswap, I think Compound and Maker are also in the index. So you can purchase the index instead of the individual coins themselves, and basically count on that appreciation. There are also social trading sets on token sets, basically individual people or influencers, quote unquote, that'll go on there, basically create their own portfolio, and your money will move with how they make their trades. So it's kind of an automated way to invest and do trading. So some of these are more simple, and they'll hold something like just Ethereum and USDC, and it'll rebalance when, let's say Ethereum is kind of taking a nosedive. It'll rebalance the fund, put it all into USDC, and wait until the market is safe to basically enter again. So this stuff is really cool. I think that this could represent a big part of the future. We just kind of have to see on how they develop. Right now, it's kind of hard to participate because of high gas fees and stuff. So last one, I kind of mentioned it. I'm not even really going to write it out because I don't know enough about it yet, but fixed income rate markets, things like derivatives and options, different ways to trade and use assets. Those are also being worked on, so you can check out. I think one is called Melon. This is basically a decentralized hedge fund. And I'm gonna go back into this a little bit later as well, but this is an interesting concept in itself. Especially considering that hedge funds right now have so much control. If you decentralize it, then they don't really have that same kind of effect. So, how can DeFi help wealth inequality? Well, some people might say, aren't the wealthy just going to stay wealthy? Possibly, but really what this represents, I don't really want to say that you're gonna suddenly make a ton of money, or suddenly poor people are gonna be rich people. It's not really the point. This is an even playing field. We don't have an even playing field right now. We are playing in a game that is designed to not benefit us, and that's a problem. Do the derivatives directly follow the existing equity market, i.e. Black-Scholes model for options, pricing, etc.? I don't know. I'm not familiar enough with that to comment on it right now, but I will take your question. I will write it down, and I will put it in my reading list, and I will try and answer it next time if that's cool. So, like I said, this is representing an equal playing field for us. So, something that I think was really interesting, I saw a comment, and we're just talking about the decentralized hedge funds. Somebody said on Twitter, I think it was Chamath, I don't know how to say his last name. He said that currently Wall Street Bets is the world's largest hedge fund, something like that. Think about how much gravity that has, how much power that has. Somebody that could challenge the actual traditional hedge funds these days in a democratic way. That, to me, is pretty incredible. I think that we can definitely see stuff like that in the future. So stuff like Melon, stuff like token sets will enable us to kind of even that playing field to play that same game without having to be a institutional traditional investor or somebody that operates or runs a hedge fund. Together we can make the rules. Together we can decide how those things are going to evolve, and what trades we're going to make, what investments we're going to make, and that to me is really, really awesome. Another way that we can kind of mitigate wealth inequality is storing value in something that is not an inflationary asset, like the US dollar. So fundamentally speaking, Bitcoin is a deflationary currency, which means that over time, the supply is going to increase very slightly, and then it's going to cap out. Once it hits 21 million Bitcoins, so I'll write this out for you guys. Oops. So Bitcoin will ever only have 21 million Bitcoin. And I think the final Bitcoin is going to be mined in 2140. So, in other words, the supply is not going up very fast. In fact, hardly at all. And as that time goes on, its price continues to rise. So, as Bitcoin continues to rise, it basically becomes more scarce and more valuable over time. The Federal Reserve can't print more Bitcoin if they want. They can't just inject more money into the economy. This is the supply, and this is how it's always going to be. They are also working on ways to make Ethereum deflationary. I don't know if it's going to work exactly the same way. In fact, it won't. But the way that this could happen is via a proposal called EIP 1559. And this will basically change the way that miners get rewards. And every time that a transaction gets processed, basically there'll be like a burn rate. So some X of Ethereum is just going to be burned off the platform and disappear, right? Colecorn asks, so ideally in a crypto-based economy, how would crisis be responded to when liquidity is lost and people choose to hold their funds rather than spending? Again, another great question. I'm not sure. I've kind of been trying to wrap my head around what the future looks like if we suddenly, if tomorrow there was a mass shift over to cryptocurrency. I'm not really sure what would happen. I need to do more reading about it, number one. And number two, I think it's hard to imagine because right now we have so much invested in traditional finance. People have their Social Security, their 401ks, their retirement funds. Those could theoretically just be wiped out if that were the case. 2 questions. Have you looked into the theory of Bitcoin entering bull cycles after it's having cycles? If yes, will you be exiting and re-entering the market during bear market phase? I do. I have looked into that stuff, or I'm familiar with it. What he's basically saying is that there's something called a halving in Bitcoin, and once Bitcoin reaches a certain point in its block size or its block number, the Bitcoin mining reward is going to be cut in half. I think this just happened last year, and this is basically why it's going to take so long to get to 21 million Bitcoin. I think right now there's 18 million plus in circulation, maybe a little bit more, something like that. But the block rewards are going to be reduced over time, so it's just going to continue to take longer to get to this 21 million number. So some people feel like this is a good time to invest. When a halving occurs, price is going to go up because demand is going to go up and supply is going to go down. I don't really have any plans to invest or reinvest during the halving cycles. I just kind of am counting on this stuff continuing to grow because I see the potential in it. So personally, no. But it's not a bad strategy if you're trying to take profits. Second question. Oh, you already answered that. So not really is kind of the answer, but it is definitely a lot of people are considering that. So just to sum up, the idea here is that your money appreciates over time instead of depreciates. The US dollar is on track to become very inflated, dangerously so, in my opinion. Right now, we are getting ready to tack on an additional $1.9 trillion in debt to an existing, staggering $27 trillion in debt. This is not sustainable. Look, I understand. Obviously, some of this is necessary. I know we have to protect people in COVID times and make sure that they can live and pay their rent and buy food and stuff. But the problem is that just long term, this is really damaging. Every president promises to reduce the debt, and then every time it goes up. This is really scary to me. And you can imagine a world where the U.S. dollar is maybe not worthless, but doesn't really get you a whole lot of buying power, right? So I think right now the US dollar is currently inflating at 2% roughly a year. That's really fast. So if anybody's bought a cheeseburger lately and it's cost them $15, I'm sure you can resonate with that sentiment. So now I want to talk about some of the downsides. Obviously, there's always a problem. It looks like we have a question. Let's see. Deflationary currencies inherently benefit lenders. So for average Americans with, say, mortgage and student loans, would the deflationary side of crypto be beneficial? I would assume so, because if your loan rate, you're going to pay more interest over time anyways. So if your money is actually growing with that rate, then you're probably going to have more buying power to basically pay off your loans. Right now, you are kind of going to get screwed over your loans because over the next 10 years, this is happening to me. I'm doing my MBA, and I just took out a loan, so I'm going to have to pay that off over the next 10 years. But in 10 years, my dollar is going to be worth a lot less. So, I think that this kind of helps solve a lot of those problems. But you're asking really good questions, and I'm actually going to take a lot of your stuff and turn it into reading material. So thank you. So what are the downsides to DeFi right now? The current state of Ethereum is kind of slow and expensive. And this is essentially because the way the network was initially designed was also to have these upgrades over time. But I don't know if it was ready for the kind of activity it's having right now. So the reason it's slow and expensive is because platforms like Uniswap and Aave have billions of dollars in locked value. I think overall, if you guys want to go check, there's a really great website called DeFi Pulse. Currently, there's $33 billion locked across DeFi platforms. This is news to me. I didn't know that this stuff was happening until like last month. So there's a lot of activity. Uniswap and Aave alone, each I think have somewhere between $4 and $5 billion being traded on their platforms. So This stuff is happening. But when activity is really high, Ethereum can't really handle the load. Right now, Ethereum is built to do about 15 transactions per second. It's fairly slow by Visa and MasterCard standards. So when a ton of people are trying to get their transactions in, the gas fees goes up. If you don't know, whenever you make a transaction on the Ethereum network, you have to pay a gas fee. These fees basically go to help pay the miners and incentivize the network to basically continue running. When I first was doing stuff on Ethereum, these fees were like, I don't know, 25 cents. But now they're closer to, I would say on average, you're probably going to pay somewhere between like $5 and $25, which is just simply too high, especially if you want to transact in low amounts. So basically, gas fees come up as network congestion grows, and this is obviously bad for the platform. Nobody wants to wait minutes or hours for their transactions to be verified, and they also don't want to pay these high fees. But the good news is ETH 2.0 is coming. So Ethereum 2.0 basically promises to change the way that the Ethereum network runs so that it becomes more scalable and cheaper. And there are already upgrades going out as recent as last December, actually. What they call the Beacon Chain was launched. And the Beacon Chain is basically the first step into scaling the Ethereum network. This is phase 0. And people are hoping and are optimistic that phase 1 will come sometime this year, hopefully in the first half of 2021. And once this happens, Ethereum will basically be able to increase its throughput by 64 times. So this 15 transactions per second becomes around 1,000. So the Ethereum network is basically promising to get much, much faster over the next couple of months, which is really, really exciting because there's all this traction, all this excitement around this stuff, but it sucks because you can't really play around. Like, I really want to play around, but these fees are too damn high. And especially if you go and do something like a smart contract, you try and interact with like Finance, sometimes the fees are like 1.5 ETH. Because there's so many transactions that are bundled up within it. And like, I can't afford this. Most of us can't, right? So this is going to be a really exciting time because I think this is when you're going to see adoption really take off. So, but some of the other problems still, you're placing your trust in software. There's no central custodian that you can count on that you can call if you make a mistake. If I send money to the wrong place, that's it. It's gone, right? So this is inherently a very scary thing. This is what we're talking about with user error. You really have to be careful when you are doing stuff on the Ethereum network or really any blockchain network right now. And the last thing is just similar to this, lack of insurance. Nobody's there to protect your loss of funds. So if you lose your stuff, you lose your stuff. I have made plenty of mistakes, I promise you guys. Which is, I've made them so I can tell you guys about them so you don't have to make those same mistakes. But, these are the big problems kind of plaguing this right now. But I'm not scared that these things aren't going to be solved. In fact, I'm pretty confident that the way that they're moving and the way they're developing the network is going to be really, really cool long term. So, how are we going to drive adoption, right? Right now, people are pretty pissed. Wall Street kind of got exposed last week a little bit, and people are starting to realize that these centralized authorities that run our financial systems are not clean. Surprise. People are tired of getting fucked over by the centralized systems that were built to basically oppress them, to not allow them to play the same game that everybody else is playing. The veil is starting to fall and the system is being exposed. So what are people going to do when the US dollar is one day worthless? I'm not saying that's going to happen, but it's already kind of happening in some respect. The US dollar is just going down and down. Would you YOLO 10K on ETH today? That's a really hard question to answer because you're essentially almost asking me if the price is going to keep going up. Here's what I'll say to you. Don't invest anything in crypto that you aren't willing to lose. the market is still very volatile. The stuff is still really new. I would, relatively speaking, put this at like where we're at compared to the internet. We're like maybe early 2000s internet. So that means the price could fall 50% tomorrow. I don't know. What I will tell you is that I'm sure it will continue to grow and rise over time. So even if you end the year down, that doesn't mean in 5 years it's not going to be up. What are the technical challenges which cause throughput to be so low right now and in the near future? So I don't want to go too much into it because it's kind of complicated, and this might be its own episode on itself. But basically, right now, the Ethereum network, what they're called consensus protocol, is called proof of work. And what this means is basically that when you broadcast a transaction to the network, the miners, the computers in the network, are going to grab that transaction. They have to solve this really complex puzzle. Once they solve the puzzle, that transaction becomes immutable and they can never be changed again. So the reason this is not scalable, though, is that you can only scale as you add computers to the network. So there's a limit that they can do now. And this is just not scalable long term. In order to go from 15 to 1,000 this way would be way slower, way more expensive, and it would use a lot more energy, which is another big concern with proof of work. This is actually also how Bitcoin works right now. But long term, something called proof of stake will be the consensus algorithm. And basically what this means is that you will be asked to put up a large sum of Ethereum, like 32 is what it is. It's the minimum. And the network now knows that it can trust you because you've basically put up this Ethereum as collateral. So if you try to do any sketchy business, the network's just going to take your money for making mistakes. Let's see. We had another question. Do you think Doge will get to 50 cents? Don't buy Doge. That's all I'm going to say. Any other questions? Yeah, I can briefly talk about the lockup phase. So the lockup phase is what's happening now. That's the beacon chain. So basically everybody's been asked to come and stake their Ethereum basically as a promise that they're going to help be a validator in the future. And that's basically what's happening right now. So people are starting the early phases of this proof of stake work. They're staking their Ethereum to start processing transactions. And then eventually the network is going to have a bit of a hybrid proof of work, proof of stake. And then eventually it's going to be only proof of stake. And that'll be much more efficient and energy friendly. But like I said, I think I'm going to do a more in-depth episode on the consensus algorithms and how they work, and basically the different kinds of what they call distributed ledger technologies that are coming out. So to kind of sum up, DeFi is a better way, in my opinion. This is a better way to do finance. It's a more fair way to do finance, and to let everybody be involved kind of in whatever capacity they want. I really want to help educate people so that they're prepared for when the time comes. I don't know when this stuff is going mainstream. I can't predict it. I couldn't have predicted that Ethereum, would have skyrocketed as much as it did in the last week. This space is really hard to tell where it's going, but the best thing that you can do is learn about it. Learn about what's working, what's not working, who has the good projects, who has the good teams, those kinds of things. The tech is going to get there. I don't know if it's going to be next year or 5 years from now or 10 years from now, but when that shift happens, it's going to be fast and it's going to be intense. That's what I do think is going to happen. We're reaching a breaking point right now in our democracy, in our financial systems. More than ever, the biggest CEOs in the world are coming out against hedge funds and the people at the top and saying that you're not letting everybody play the game. And now they're pointing to DeFi as a solution. So there's a lot of traction right now, and there's a lot of people that are interested. So I really want to just help people get involved and understand why this stuff is important. Last thing I want to say really is just that we're heading in a dangerous direction and we need to change. So like I said, even if it's in a year or 5 years, start preparing now. It's like you're preparing. It sounds like I'm telling you guys to prepare for nuclear winter and store your assets. But in a way, that's kind of what I'm saying. Prepare for a potential downfall of the U.S. dollar. I don't know if that's going to happen directly, but the value is going to go down. It already is, especially with all the debt that we have. So would you recommend someone participate in proof of stake? I think it's up to you. The only downside to proof of stake is if you do want to stake, right now you need 32 ETH. You can also join a staking pool. So there are a couple different platforms that are doing this. One is called Staker. I can't really think of too many off the top of my head. And so you can stake with any amount. The only thing is that you're going to have to lock your Ethereum up when you do stake. So I think the minimum is 1 year. And then I think you can do 2 and 3 years. And I think you get higher yields if you do 2 or 3 years, something like that. Any insight about yield farming? What exactly it is and how does it function? Sure, I can do a quick overview of that. So yield farming is basically if you have a trading pair like Ethereum and USDC, I'm gonna go provide liquidity to the pool of this trading pair. So in order to do that, I'm gonna put in equal amounts of Ethereum and USD. So if I put in 1 Ethereum, and that's 1700 USD, well, I should say USDC, I'm now gonna get some percentage of this trading pair's pool. So the thought process here is that you make money 2 ways. One is you will earn off of the transaction fees that are taking place. So every time a trade happens, you'll get some tiny percentage of it. And then you also can earn if the money appreciates. So if Ethereum goes to $2,000, you are now both entitled to 2,000 USD coin, as well as whatever additional equivalent of USD, or of ETH. So that might be, I don't know, 1.1 or 1.2, something like that. So because you purchased a percentage, when that number goes up, you actually get more of both of those assets. Oh my gosh, look at all those biddies. Awesome. So yeah, this is pretty much all I got for you guys today. I hope that this was a pretty good overview of decentralized finance and kind of why it's going to be important for the future. I've got lots of ideas for future episodes, so I really encourage you guys to keep coming back, keep asking me questions. It really helps me learn about what you guys want to learn about, and also helps me learn. Sometimes it can be hard to figure out all of the things that I need to learn about, so that's really helpful. But if you guys had a good time today, I encourage you to follow, like, subscribe, do all that regular shit. Go follow me on Twitter. I'm always tweeting about this stuff. Honestly, just really excited to have people here. People excited that are excited to learn about this stuff. I've been passionate about this for a really long time, and it now finally feels like the right time to share my passion with the world. So thank you guys all for hanging out today. I am going to be posting this on YouTube and Spotify and stuff, so if you guys want to come back and reference anything, you're more than welcome to. It's been a pleasure, and I'm looking forward to seeing you guys next time. All right. Thank you, everybody. Bye.